Hey everyone, it's great to see you again. Are you excited to start investing and watch your money grow? I totally get it. The idea of making your money work for you is incredibly powerful. But hold on just a second. So many people get swept up in the excitement. Hear about a hot stock from a friend and dive in headfirst, only to see their hard-earned cash disappear. It's a painful lesson, and it's one I want to help you avoid. Think of it like this. You would try to climb a mountain without the right gear and a map, right? Investing is the same. It requires preparation. So, before you put a single dollar into the market, we need to build a solid foundation. In today's video, I am going to walk you through the 7 crucial steps you absolutely must take before you start investing. Following these steps will not only protect you from common pitfalls, but will also set you up for long-term success. So, grab a notebook, and let's get started on your journey to becoming a smart, confident investor. First things first, and this is non-negotiable. You need to build an emergency fund. What is an emergency fund? It's a stash of cash, typically 3 to 6 months' worth of your essential living expenses, set aside in a high-yield savings account. This isn't your investment money. This is your life happens fund. Think about it. What if your car breaks down? You have an unexpected medical bill, or you lose your job. If your money is tied up in the stock market, you might be forced to sell your investments at the worst possible time, potentially locking in a loss just to cover these costs. Your emergency fund is your financial safety net. It gives you peace of mind and the stability to ride out market volatility without panicking. It's the bedrock of your entire financial house. So, before you even think about stocks or bonds, calculate your monthly expenses, multiply it by at least 3, and start saving until you hit that goal. Trust me, your future self will thank you for it. Step number 2 is all about tackling a major roadblock to wealth. High-interest debt. I'm talking about things like credit card debt, personal loans, or any loan with a high interest rate, often double digits. Why is this so important? Well, let's do some simple math. The average historical return of the stock market is around 8 to 10% per year. If you have a credit card charging you 20% interest, you're fighting a losing battle. The interest you're paying on your debt is erasing any potential gains you might make from investing, and 10 some. It's like trying to fill a bucket with a giant hole in it. Paying off that high-interest debt is a guaranteed return on your money. Every dollar you put towards that 20% interest debt is a guaranteed 20% return. You won't find that kind of guaranteed return anywhere in the investment world. So, prioritize creating a debt repayment plan. Focus on your highest interest debts first, and aggressively pay them down before you start investing significant amounts. Clearing this hurdle will free up so much more of your income to invest and grow. Alright, step 3 is where we start looking forward. You need to define your financial goals. And I mean, get specific. I want to be rich isn't a goal. It's a dream. A real goal is something you can measure. Why are you investing in the first place? Are you saving for a down payment on a house in 5 years? Are you planning for a comfortable retirement in 30 years? Or maybe you want to pay for your child's education in 15 years? Each of these goals has a different time horizon and will require a different investment strategy. For a short-term goal, like that house down payment, you'll want to be much more conservative with your investments because you can afford a big loss. Right before you need the money. For a long-term goal like retirement, you can afford to take on more risk for the potential of higher returns because you have decades to recover from any market downturns. So, sit down and write out your goals. How much money will you need? And when will you need it? Having this clarity is like having a destination plugged into your GPS. It'll guide every single investment decision you make from here on out. Now we move on to step 4, and it's a bit of personal reflection. You need to understand your risk tolerance. Risk tolerance is your emotional and financial ability to handle swings in the value of your investments. Are you the type of person who would lose sleep if your portfolio dropped 10% in a week? Or do you have a stomach of steel and see market dips as buying opportunities? There's no right or wrong answer here. It's about knowing yourself, your age, your income stability, and your overall financial situation all play a role. Generally, the younger you are and the further you are from retirement, the more risk you can afford to take. Why? Because you have more time to recover from any losses. Someone nearing retirement, on the other hand, needs to be more conservative to protect their capital. Many online brokerage platforms have questionnaires to help you determine your risk profile from conservative to aggressive. Be honest with yourself. Choosing an investment strategy that doesn't align with your risk tolerance is a recipe for disaster. It can lead to panic selling at the bottom or taking on way too much risk and getting burned. Know thyself, investor. Step 5 is a big one. You need to educate yourself. You don't need a PhD in finance, but you do need to understand the basics. What's the difference between a stock and a bond? What is an ETF or a mutual fund? What do terms like diversification and asset allocation mean? Jumping into the market without this basic knowledge is like gambling, not investing. The good news is, there are more resources available today than ever before. You can read books by legendary investors like John Bogle or Benjamin Graham. You can listen to reputable financial podcasts. You can watch educational videos right here on YouTube from trusted creators. Start with the fundamentals. Learn about different investment vehicles and the concept of passive investing versus active investing. Understand that investing is a long-term game, not a get-rich-quick scheme. The more you learn, the more confident you'll become, and the less likely you'll be to fall for hype or make emotional decisions. Dedicate a little bit of time each week to learning. Your financial future is worth the investment of your time. Okay, we're getting close. Step 6 is to choose the right investment account. This is the container that will hold your investments, and the type of account you choose can have a huge impact on your taxes and long-term growth. In the U.S., for example, you have options like a 401k or 403b if your employer offers one. These are fantastic because they often come with an employer match, which is literally free money. Then there are individual retirement accounts, or IRA. You have the traditional IRA, where your contributions might be tax-deductible now, and you pay taxes in retirement. And you have the Roth IRA, where you contribute after-tax money. But your qualified withdrawals in retirement are completely tax-free. For goals outside of retirement, you might just use a standard taxable brokerage account. Each account has its own rules, contribution limits, and tax advantages. It is crucial to understand these differences and choose the accounts that best align with your financial goals that we defined earlier. Do your research and figure out which combination of accounts makes the most sense for your situation. And finally, we've arrived at step 7. Create a plan and automate it. You've done all the hard work. You've built your emergency fund, paid down debt, defined your goals, understood your risk tolerance, educated yourself, and chosen your accounts. Now, it's time to put it all together. Decide on your investment strategy. A great starting point for many beginners is a simple, diversified portfolio of low-cost index funds, or ETFs, that match your risk tolerance. For example, a mix of a total stock market index fund and a total bond market index fund. Once you have your plan, the most powerful thing you can do is automate it. Set up automatic transfers from your checking account to your investment accounts every single payday, whether it's $50 or $500. Then, set up automatic investments into your chosen funds. This strategy is called dollar cost averaging. By investing a fixed amount regularly, you buy more shares when prices are low and fewer when prices are high. Most importantly, it takes the emotion and guesswork out of the equation. You're not trying to time the market, you're just consistently investing for the long term. This is how real wealth is built slowly, steadily, and automatically. So there you have it, the 7 essential steps to take before you invest a single dollar. Build an emergency fund. Pay off high interest debt. Define your goals. Understand your risk tolerance. Educate yourself. Choose the right accounts. And create an automated plan. I know it sounds like a lot, but taking the time to build this foundation is the single best thing you can do for your financial future. It transforms you from a gambler into a disciplined, long-term investor. Investing is a marathon, not a sprint. By following these steps, you're setting yourself up to cross the finish line with confidence and security. Thank you so much for watching. If you found this video helpful, Please give it a thumbs up, and do you and T forget to subscribe for more content to help you build wealth and live a better financial life. Let me know in the comments which step you're working on right now. I'd love to hear from you. See you in the next video.